Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Dearborn and Maddie Radner on the Nasdaq Market Intelligence Desk, as well as David Waddell, CEO and Chief Investment Strategist of Waddell and Associates. And we're here to discuss how investors should interpret what the administration is signaling. It is great to have all of you with us. Welcome back, David. Great to have you back on the show.
Great to be with you.
It's interesting. If you take a look at the market year to date, it's at 1.75%, right?
Perfect.
Kind of flat-ish returns, but if you kind of look under the layers there, it's been an interesting 2025 for sure.
Yeah, so we just got a do-over, which is nice. I mean, if you go back to the first trading day of the year, the 10-year bond yield is basically the same. The level of the S&P 500 is basically the same. So all the craziness that we've gone through over the last 5 months, that's sort of forgotten, right? Now we're looking forward and things look a little bit better. And the behavior of the market today sort of signals, I think, what we can kind of expect going into the rest of the year, which is that economic data beneath all of this political sword fighting is resilient, will continue to be resilient, supported both by, you know, the nimble and capable corporations in America, but also by the tech upgrade cycle and the CapEx. And so, you know, we just get distracted from the good news by all the crazy news.
Yeah, well, I mean, I think what's encouraging is that CapEx projections haven't changed. And that's been
so DeepSeek didn't matter. I was a little worried about that too,
yeah.
Right? That maybe DeepSeek was a signal that you didn't have to spend as much to get as much, but that has not been the way Silicon Valley has reacted.
Yeah,
so CapEx is still very high.
Chris, we've been talking about this for, let's call it 5.5 years now, you know, since the beginning of the pandemic, just how resilient corporations have been and have operated quite well in many cases, and this is just another scenario of that. Earnings season was not as disastrous perhaps predicted.
The earnings season was pretty good, right, this last quarter. Better than expected, 12.5% on the growth rate there. PEs are looking pretty good for the S&P right now. Small cap, a little bit of work to do, but they've got a bit of an overhang there. Interest rates are definitely impacting that for the future. But originally, you go back to where we were in December, we're maybe projecting only 2 rate cuts this year, and that's where we are right now. You know, the inflation data has been kind of a little bit softer. Right, PCEs come in, CPIs come in a little bit, PPIs come in. Unemployment rate is still hanging at 4.2%. We get a big number Friday. JOLTS data today was okay. You know, so the hard data is pretty good. Now you look at the soft data. It's been a roller coaster because you're looking at sentiment, CEO sentiment, consumer sentiment. You know, you go back over any 2 or 3 week period right now, and people are just whipsawed because they're paying attention to what the headlines are, and the headlines, to your point, is exactly what's driving the markets recently. If you bought the dip, you're looking pretty good right now. If you're a short-term investor, if you didn't sell out, you're looking pretty good because now you've still got a positive return. And you forget, we're used over the last couple of years, post-COVID, for outsized returns on the S&P, the Nasdaq 100, you know, the Mag 7 names, the FANG names. They kind of outperformed the rest of the market and carrying on the coattails. You know, when you look back at it, corporates do find a way to innovate and move forward, and the only reason driving that is profitability, and that's what they're there for. They're there as a public company to drive profits for the investors.
And we saw a similar pattern, you know, on a shorter term scale with COVID. If you held onto it, your returns were generational, and you also picked up in your 401k, as an example, shares at an incredible discount.
Yep.
So it's, you know, there's a little bit more rockiness in between. Right.
March 2020 was a buying spree.
Yeah.
If you were bold enough to, and if you were bold enough to put your money to work, as opposed to being afraid because you didn't know what was going on, you were well rewarded. And even if you were late to that market, the next couple of months after that into the back end of the year was still pretty good.
Yeah. All right, so Maddie, look, I've been asking this question for a number of years now. When are your small caps going to catch up? Is this the environment potentially?
Yes, today. No. As Chris mentioned, they still have some catching up to do. I think it is worth noting, though, the Russell 2000 is up 5% this quarter. Microcap has seen a nice rally, up 10% this quarter, but they are still down about 5 to 6% so far this year, underperforming the S&P, which is now in the green for the year. That said, now that we've seen a little bit more certainty around the tariff headlines, I think the focus is now on when the rate cut is going to be, and that could be a really big tailwind for these small cap companies. Small cap companies could definitely be more insulated to a lot of the trade uncertainty that we're seeing, as 80% of Russell 2000 constituent revenues are actually generated in the US. So these small businesses have a greater protection with all the headlines that's been happening. So I think now it's, again, as Chris mentioned, really data dependent. Will there be a rate cut sooner this summer? That could really be a tailwind. There's a few things that could spark a rate cut sooner than we think. First is tariff certainty. Second is inflation. Again, as Chris mentioned, been ticking down this year. PPI, CPI, PCE is now at 2.1%, so that's looking fairly good. Employment and wages are looking stable, so I think the Fed is really going to continue to closely monitor data, and we could see a rate cut maybe this summer.
And David, this is what your latest note is suggesting. Favor what the administration has told you to favor. That's where the small caps come in.
Yeah, and you get more industrials, you get more financials, you get more materials. And if you think about small caps, they really need two things. One, they need a rate cut, which they'll get in September, I think. And two, you need recession odds to fall. So there are two data points in the last 2 days that got me really excited. One, do you realize that exports in China in April were higher than they were in March? And exports to the US were down 21%, right? So we're 25% of the world economy. There's another 75% out there, right? So we've done a lot of navel gazing around what's going on with our economy, and we told everybody else, well, go get your own economy, and guess what? They kind of are, right? So that's good. A second thing was the JOLTS report today, where we got 200 more job openings than we at all anticipated, and that was during April.
Right.
Like April was the eye of the storm for the tariffs and also for the fears and uncertainty surrounding the marketplace, was obviously where we saw the 20% drawdown in the S&P and a 30% drawdown in the Magnificent Seven. So going back to the resilience, tariffs are bad. I don't like tariffs, right? And most people thought we'd have a 10% tariff rate going into the year and then built their models around that. That's kind of where we're drifting towards. But we hadn't really seen any pull through, didn't see it in those exports, and we're certainly not seeing it in the job market. And so that's why the small caps are up today, is because what the JOLTS is telling you is recession odds are going down.
Right.
So lower recession odds, lower inflation, which was kind of the script that strategists had going into the year when they thought we'd have double-digit returns, and then they had Liberation Day panic attacks, and they took their estimates for the year up 1%, which to me is great, right? Because all of that excess sentiment got washed out, and what's happening is that the Citigroup Economic Surprise Index is surprising to the upside again. This economy just continues to take the punches and get back up and get back in the ring.
And you've seen inflows too, right? B of A's data is showing that we saw a lot of outflows because people weren't sure what to go with their money, but now you're starting to see inflows into equities over the last couple of weeks. So there's some strong data there that supports the entire thesis that let's put our money back to work here in the US, even though you found alternative investments, especially on the bond. I mean, your boons are booming, the bad pun, but and you're finding other alternatives there. The question is, how much can we really sustain here with the uncertainty of the tariffs? I mean, Friday's going to be a big headline, not just for the non-farm payrolls report, but also the China talks out of Washington, D.C. That can go either way. I mean, vols come in, the VIX is trading 18-ish right now after spiking a couple of weeks ago. One good headline, markets rip. One bad headlines, markets
we get a little bit
decimated.
more rare earths, they get a little bit more semiconductors.
Right.
End of story.
I think, and natural gas. Don't forget the natural gas exports
the
there.
Fed rate cuts and so forth, but we're just adding more debt into a system it's unsustainable.
Nobody cares. So if you look at the 10-year, I think, at 4.4%, it's telling you inflation is 2.2, GDP growth is 2.2. It's right on the dot with nominal GDP. So that is an issue, and it's something, but the world knows that with a strike of a pen or a minor flare-up in crisis, which is what happened when the 10-year got to 4.5, Bessent went into Trump's office and was like, we can't do this, right? So the world kind of thinks that we'll correct our mistakes. That's the magic of America. I think where it does show up is gold. I think the people who are really concerned, because typically, gold doesn't rise when the dollar goes up and the dollar goes down, right? So I think that's where the commentary might be on the debt, but it's not showing up to me in the Treasury market, really.
Yeah.
And you're looking at all other alternative investments too. I mean, obviously there's a lot coming out of Washington around Bitcoin and the other alternative and the coins there, but look at Bitcoin futures trading at 110, right off all-time highs right now. And yes, that has to do with a lot of regulation coming forward, or at least the pro-White House for that type of data. However, trading product. However, people are putting money to work there because it is a viable alternative investment as long as somebody's willing to pay a little bit more than you. So the gold trades right there, the Bitcoin trades right there, and the other is moving along well. Equities are moving higher now while the dollar's moving lower.
Right.
You know, where's the money going? And you can see it. All you have to do is look at what they're telling.
You can clear a 5% earnings estimate hurdle for the second quarter when GDP now is at 4.6.
Right.
Right. I mean, yeah.
I mean, Maddie, it makes you wonder, is the market just becoming tolerant, right?
Mm-hmm.
You know, the whole taco.
Yeah, I think we're still seeing a lot of moves based on headlines. Like yesterday, we saw a breakdown of the U.S.-China trade, the doubling of the steel tariffs, and the Ukraine kind of geopolitical tensions come back into the picture. So markets were down. Today, we're seeing a little bit more confidence. We're seeing trade de-escalation headlines, resilient hard data, and better than expected data. The focus is still on how strong the Q1 earnings season was, with S&P growth over 13%, which is way above what was predicted at the end of last year, which was only about 7%. So people are looking at the strength of the U.S. equities here.
Yeah, well, David, it makes you wonder, the market's expecting this is going to be our environment for the next 3.5 years.
Yeah.
Right. So it's not going to go back to the way that it was prior to, it's not
Or
going
at
to
least
be like 1.0.
until the midterms.
It's not going right. But, for all intents and purposes, in the more foreseeable future, this is what the market is dealing with.
Right.
That's how it feels.
Yeah, and so it's a little bit like you said, we're building up a Trump tolerance, right? Like there's a lot of cry wolf, there's a lot of animation, and yet we'll get a JOLTS report like today, or we'll get an earnings season. Like, it's really kind of prove it out season, I think, for the markets. And so my least favorite month of the year is this month, frankly, because earnings season's now over. We're in an air pocket. And so really all we've got to talk about is kind of the headlines coming out while we're getting
And
the
sell in
sausage
May and go away.
Yeah, we're getting the sausage getting made. And then, can we overcome the 5% earnings expectations for Q2? Yeah, but we won't know that for a month or so. So I think at a 4.4% treasury, that translates into about 21x on the S&P, which is about where we are. So I think the market's pretty fully valued, at least if you're looking at the S&P. There are opportunities down the cap spectrum. So now it's really earnings that are going to pull us higher, and the estimates right now I think are 10%, 11% over the next 12 months from where we sit today. So that could happen unless we have something fall apart. But it's going to take a while to sort of get there.
Yeah, well, I mean, from a longer term perspective, since CapEx is still where it is and companies are making investments, right? That's when you're starting to look at 5-10 years down the line and watching these investments translate into, let's call it the next, well, I mean, 5-10 years might even be too far out, but the next phase of what emerging technology evolves from here.
Well, go back to 94 to 2005. Which included the dot-com crash. Earnings were growing at double digits for that entire time period. And by the way, investors made a whole lot of money over that time period, even having to endure 2000, 2001 kind of lows. And so I think we're in another tech upgrade cycle like that. And I think that's the massive upforce that takes these other distortions and sort of dispels them as we get
right. And Chris, that's a great point that David makes, because this is why you have averages, right? But you're always going to shake out the outliers at some point.
You're in another innovation stage here for corporate America, especially with the AI and the tailwind that's giving. That's just moving along quicker and quicker, and it's going to pull in a lot of infrastructure spend. It's going to pull in a lot of jobs over the next 5 to 10 years as the plants start to get ramped up, and a lot of spend, especially on the utility side. I mean, look at the announcement today with Meta and Constellation, right, going for nuclear power. That just tells you where it's going. So there's going to be innovation there. That's going to drive earnings for a lot of companies. And that's going to be that new cycle for corporations, especially those who are partaking in that, to move ahead. Now, if you move to other sectors, it's going to be a little bit harder, right? Manufacturing maybe will get up there. Industrial is going to be hurt for a little bit, until there's clarity. Consumer is going to ride that wave back and forth. We were talking about how tough consumer companies have had it during the earnings cycle, but now towards the tail end, you're seeing a lot of companies do very, very well and being rewarded for it, right? So it's the have and the have-nots. But then you have also, on that same earnings cycle, you had a lot of companies who reported early in the quarter who withdrew guidance, and they were punished for that, because generally companies who do report guidance do get a little bit better of a bump because the analysts have something to model to for the following year. So if we return to normal there, you can see multiple sectors kind of push this along. I don't know about the 3 to 5% by year end, but definitely a positive return depending on the headlines.
Right. The market's always going to climb a wall of worry at some point. Just like consumer,
That's what
there's
we do.
always going to be cyclical.
That's what we do.
Yeah.
You know, I mean, June is, cyclically, June is one of the worst months in the
Because
market.
you're in a vacuum,
40%
and the
odds of
headlines
going up.
the headlines amplify
Right.
it so much, and you kind of like have the algos communicating with each other, and there's nothing else to trade but
I mean,
the
if you look at
headlines.
the Nasdaq 100 was up almost 10% in May, right? I mean, that's a phenomenal run, 9.5%, 10%, right? That's a phenomenal run.
And that goes back to the
Doing really
catch-up
well.
thing you mentioned earlier. You know, from that bounce off the low, which was 19% or so until today, half of that was technology and consumer discretionary. So there are a whole lot of other, parts of the market that really didn't fully participate in that.
Correct.
Which is, you're seeing some catch-up today in the industrials and the financials and the small caps, and like I think the equal weight at S&P is up twice as much as the S&P, or it was when I was downstairs.
Yeah.
So I think there is some catch-up that can happen here too, which is a sign of health, in
Right.
my judgment.
Yeah, well, I mean,
Broad-based participation.
exactly, and that's the question we've been asking prior to the volatility we saw in the market this year, is when are we going to get that broad-based participation? So to see that outperformance is quite encouraging, that there are other opportunities out there besides the Mag 7. And hopefully the small caps will get some follow through at some point, and not just a 2-3 day run there.
I think I can.
Well, I mean, look, it gives you an opportunity to pick other things and look at other ideas.
Well,
which-
and the valuations are good. On that, you can buy the mags at 28, you can buy the S&P at 22, or you can buy your small caps at 14.
Right. And the mid cap last year was doing very well. It was making a nice run right through the election, especially right after the first couple of cuts from the FOMC. So you had expectations there. We got to get back to those expectations for the smaller and the mid caps to kind of participate along.
Well, that was the thesis going into the year, that European equities were so undervalued that the risk was to the upside. That move was happening regardless of the uncertainty that we're seeing here in the States. So sometimes that valuation argument does hold some water.
It does, but then you got to get the thundering herd heading that direction too. Like, everybody decided it was time for internationals, and so the money actually got allocated more than just the lip service. And then you got an 8% decline in the dollar, which of course ends up being 8% lift in total return for those investments. And so what we need is the herd to take small caps seriously rather than just talk about it, go to it. And once they do, because of the limited liquidity in the space, the moves can be dramatic.
All right, we will leave that on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.